my worst losses becomes from that conviction of, this is a long, it cannot be, that fighting between the fundamentals and what the price is telling you. Like the price is telling you, no, bro, I'm going down. Like, why would you keep buying? You eventually will be right on the small caps. Like eventually you will. The market could be more irrational, that you can be solvent.
Oh yeah, for sure. Yeah,
you could blow up before you're right.
Yeah, so you'll eventually be right, but you might not survive. So can we hone into what you just mentioned about your drawdown a little bit the past month? So you're saying you're experiencing a drawdown because it's okay. Do you need some tissue? We're here today in sunny Los Angeles with a trader who famously turned $2,000 into $1 million. Eduardo is a Spanish-speaking educator in the trading space, and he's one of the traders I respect a lot for his commitment and transparency. In our conversation today, he discusses openly about his position recycling strategy in trading, and as well as his recent 40% drawdown in his P&L over the span of 3 weeks. In today's podcast interview, you're going to learn how to make a living from trading, how to develop a risk-controlled small cap trading strategy, how to deal with drawdowns and mature as a trader, and how to make trading a meaningful career. Make sure to smash the like button and get ready for a very heartfelt and insightful podcast. We're here today in Los Angeles with a trader who famously turned $2,000 into over $1 million in profits. Thank you for being so open with us today, Eduardo, with our audience. How would you describe your trading and what kind of trader are you?
I would say first I'm really into a niche, so I only trade small caps.
Okay.
That's like my thing. And then what would characterize my trading would be the recycling of shares. I remember that I sent you once a trade of mine. You were like, oh my God,
You're one of those people with one chart, it would be like a million arrows on there.
Yeah, totally, totally. But that's like the way I do it. If you see me trading live, it will make sense. Like it will make so much sense. Once you see the picture, it's like crazy. But when you see it, like I'm just recycling shares and I have like a core idea and I take advantage of the noise on that idea, you will get it better.
Yeah.
That's okay. It's more like position sizing and risk management more than taking profits right away. More than scalpy kind of way.
Yeah. We're going to dive into that a little bit later, especially about recycling shares, position sizing, and risk management. Sure. So are you predominantly long biased or short biased?
I'm price action driven, so I'm
That's
like
good.
50-50. Yeah.
Okay. And strictly on small caps?
Strictly on small caps, yeah. Every time I try to trade like mid caps or something like that, I screw up. So, yeah.
And how long have you been trading now?
I've been trading like for 8 or 9 years.
Okay,
probably.
so it's been a while.
Yeah.
How did you get into trading in the first place? Like, did you have a real job before getting into trading?
Yeah, of course. I remember I was in the corporate world, I think, when I started digging into trading. But then as I was getting into trading, I tried to get jobs where I can be more flexible with my schedule.
Yeah.
So I got like an insurance broker kind of deal.
Oh.
And I did that for a while.
Okay.
While I was trading.
So you were trading part-time while you were working that full-time job?
Like I didn't make any money with trading the first probably 3 years or so.
Oh, okay. So it was your job at the time as a broker that kind of got you through those 3 years.
Yeah, I left the corporate job. I was doing some engineering things. And then I went to this insurance broker thing just because of the schedule, just because of the flexibility that it gave me. And I could trade while I was, working. Yeah, that was back in Venezuela. So.
Oh, okay. So you were trading stocks when you were back in Venezuela?
Yeah, yeah. I started when I was in Venezuela. I started especially learning about all these things. I remember I made a trading and investment course where I saw like Forex, futures, blah, blah, blah. All those things. And like volatility and liquidity really got my attention. And I was like, okay, if I want to make, because I was doing the MBA thinking that it will give me an idea to get into trading and to
Yeah.
get to, you know, manage my money and stuff.
Oh, it'll give you an edge because you know finance.
Yeah,
Yeah,
you know,
you know,
it's
finance.
such a great idea of mine. But then I remember that it was not it. And I did this course, and I saw that if I want to be a day trader, I have to get instruments that would be volatile and liquid.
Yeah.
So I started digging in, and I saw small caps or penny stocks back then
Okay.
were like the thing of volatility and liquidity for a small account.
Yeah.
And I saw, obviously, back then when you put that, team size was all over the place.
Yeah.
And that's how I started learning about small caps and all these things.
Okay. I feel like Tim Sykes is like the granddaddy
He's
of
the
everyone who
godfather.
trades small caps. Yeah.
Totally. He's like
Yeah.
everyone that trades small caps does it because of his framework. I don't know if you have seen his framework, but the bubble, you know, the bubble framework, that is the crazy run
the
up,
sector
then
hypes. Yeah.
that thing is what gave me like, okay, this thing has an edge. So that's why I focus on small caps that deep.
Yeah. No, I think it makes sense because small caps is probably, there's different like large caps, mid caps, small caps, probably the most inefficient market where there's a lot of scams, right?
Totally.
You
And-
need that to be able to make money as a trader.
Totally. And you know
Yeah.
what? I think due to the large or bigger fish, you don't get that in small caps. Like the huge hedge funds, they don't care about small caps because of the
True.
liquidity.
Yeah.
But it's a good liquidity for us that maybe if you have like less than $50,000, it's perfect for you, the liquidity that it provides.
Yeah.
So maybe a hedge fund that has to move $50 billion, they don't care about small caps. So I think that's an edge in a way, if you understand what they're doing.
Yeah. So you said earlier that you started trading when you were still in Venezuela.
Yeah.
So at which point why did you decide to immigrate to the US? And do you think that as a trader, there's more, you know, you technically can trade anywhere, right? You don't need to be in the US, but what made you decide to move here?
Yeah, well, if you guys see a little bit of Venezuela, it got into a really, really tough political and economical situation. So it was kind of crazy back then. Like we got like riots and all those things. Like it was really unstable. I got like kidnapped there, and you know, it was so unstable, and I was like, you know what, it's not worth it. But I remember that when I was trading back then, I had to had like sources of power because power went off.
Back
Yeah,
home.
it was crazy. So I think as long as you have stable internet, you could trade anywhere.
Yeah, definitely.
But if you don't, like, you got to be careful, especially if you're trading small caps. Because if you got one of those volatility things, it's not good.
Oh, I see.
So what got me into getting out of there was that crazy political and economical situation.
So at that time, how did you get the capital to fund your trading account? Because I know you struggled a little bit, just like most people would in the early stages of trading.
Yeah, I remember that I my first account was like a $2,000 account or something like that.
Yeah.
I didn't trade with that much money, and I blew that account, obviously, the first one. But we had like savings back then, and I think like I had a job, and cost of living in Venezuela was not that great, so we managed to, you know, save some money and open the accounts and obviously get the courses and all those things.
Were your friends and family supportive of you in like, you know, diving into trading, you know, like?
Well, like my wife was pretty supportive.
That's
like
good.
all the way, but like my close family, like my father, and they're like, what? Are you crazy? What? Trading? What the freak are you doing? Like, you're an engineer. Like, why would you do that?
I see.
You know, but I always been like this entrepreneurial kind of mindset where, yeah, I probably did 1 or 2 years of corporate jobs, but then I started doing this insurance broker thing. I did even, I opened up a mini golf. I had a restaurant. I had an event company. I broke all of them. I got bankrupt on all of them. But I tried until I, saw this. And I think this is the best opportunity ever. That's why I promote this thing this much, because I know the value of it. And I know that, you have to be an outlier in order to, to be successful at it as an entrepreneur is.
So how many years did it take for you to eventually become profitable? And was that after you moved to the States?
Yeah, it was after I moved to the States, because I had in my mind, I was like, okay, I can make this amount of money and I could move to the States and I could live, if I can make this amount of money on a daily basis, I could, survive.
Yeah.
And obviously I, blew a couple of accounts more trying to do that.
Yeah.
Because of I think if you treat trading as a survival mechanism or as a survival income, it's gonna be so hard for you.
It's very difficult.
Rather, if you treat it as a growing mechanism, like if you supplement your income and if you get this skill as not to pay the bills but to grow maybe get your standards higher or something like that, it's going to be so much easier for you. But if you get that pressure of trying to pay rent, you're not risking, $2,000. You're risking your whole rent. That kind of feeling will cloud you from the decisions that you need to take. And that's why I think it's so important to detach from money.
Yeah, I agree with you. And often kind of describe it as two phases. There's a going to school phase, which all the traders, like I did it, you did it, we have to go through. When you're going to school, you're not worried about, making a career out of it. You're just trying to learn the best you can and find out what your edge is, what strategies work for you. And once you can start making like $10, $50 consistently, then that's okay, I'm making money consistently, I can use it to pay bills. That's like the second phase. I think a lot of people try to do both at the same time, and that's why they sadly ultimately fail.
Totally. And you know what? That's why you have to start with small kind of money. Because if you start, because we try to, the time that we invest in trading, we try to make it worth by getting paid.
Yeah.
And that's why you bet so much at first. But then if you realize that first 2 or 3 years maybe, it's going to be like a school for you. It's going to be like developing the skill. You're going to see it in another way, and you're going to be betting $1. I don't care. But the commissions, but you don't care. If you lose $1,000 your first year, that's a huge win, like a huge win. And people are like, no, but I have to get paid this amount of time that I invested in this thing. And they don't realize that this career can probably last 20 or 30 years. Yeah.
I think that comes with you need the right expectations as well. I think a lot of people unfortunately dive into trading thinking they are going to make it work in 6 months, and they are not giving themselves enough chance by doing so.
Totally. Managing the expectations, I think that's key. And if you see it this way, if you see it like, okay, I'm making a career as a doctor or something like that, you will be going to school like 8 years.
Yeah.
And this thing, you're giving it, 6 months? Like you won't give being a doctor 6 months and that's it. You'll give it more time. Why you should give trading, which is probably one of the hardest professions there is, not because of the markets are difficult, it's because of that's a war between you versus you.
Yeah.
So it's a matter of developing the skill more than making money out of it.
So when you started making money, small amounts consistently, what do you think was the process for you? Or were there, a couple of things, 1 or 2 things that you really focused on and honed in during that process to make you realize maybe it's not one click, but you finally realize, okay, if I repeat the same process, I can make money consistently. What was the process like for you?
I think it's a matter of habits more than it was like a click for me.
Yeah.
It was a matter of going to the same process over and over again And I realized that I could make money every single week if I stick to that process. So I had to become really, cause that's why I think I have such a unique trading style. It's just because I couldn't afford to lose money back then. And with trading, not to lose money, that's crazy. But I managed to get this trading style based on risk management, that it was really, really good on protecting my gains in a way. So yeah, totally. It was a matter of process. It was a matter of sitting down on the computer, making a watch list, making this criteria for each stock. And you know what? Obviously, being in the right moment, like the market of 2020 was a blast for me. And it was crazy because it was and many people were like devastated because of that. And I was so blessed because that market was so perfect for the way I traded that I capitalized myself thanks to that market. And I think that's key. Sometimes we have a process, like a perfect process, but if we're not in the correct environment, if we're not in the correct market in order to apply that process and push it, we're not going to be able to make money. So it's a matter of keeping the process, so when the market environment sets in, you get to push it.
Yeah, that makes sense. I know a little bit about your trading style. Basically, what you really need is a lot of volume and volatility, right? For you to be able to recycle your shares in and out.
Yes.
Yeah, that's perfect segue into, tell our audience about how you recycle shares and how does that help you in terms of your risk management?
Okay, for example, first we got to dig into the bias.
Okay.
Like that's the first thing, and that's the most important thing, and that's what I teach when I teach about trading. I don't teach about my style. That would be stupid, because if someone tries to replicate me, they're gonna lose money. But it's not the technique, but the strategy. So first, you gotta know what the bias is, and that's made with criteria that I use in order to understand what a stock is about to do or what a stock is going to do. For example, if you have gappers of 100%, I focus a lot on first days because they have the most volume.
Yeah.
So if I know what a stock is going to do the first day, like in a group of stocks, for example, if you treat biotechs and you understand that biotechs that run 100%, they tend to go down from the open to the close 15% or something like that. So my statistical approach would be my strategy, would be my bias. So if the stock has dilution, if the stock doesn't have any catalyst, or the catalyst is just a really good news about their product or something like that. It's not an FDA approval. It's just a good news about their product. Stuff like that gives me this bias that I will take. Okay, it's going to be a short, it's going to be a long. Then, if it's going to be a short, what I do is, if I'm wrong in this thesis, what would be the level on the chart that will tell me that I'm wrong? So that will be my risk level. And when I have my risk level, what I try to do with all those arrows and all those things is position myself the closest to that risk level. So my average position would be close to that, and my size position would be suitable. So if that risk level is hit, I lose the amount of money that I want.
Okay. So let's say, for example, you're long biased on a stock and your risk level is $5. And let's say your risk is, let's just say $1,000. So that means if you're long, right, above that $5, that's your risk. If you're long at, let's say, average of 510,
you'll be 2,000 shares.
2,000 shares, and you'll trade around that until it either cracks $5 and you take a loss, or it goes to
or
planned
if it goes
area.
This is what happens. Like, this is when you see a lot of arrows in my chart. This is what happens. It trends up, starts trending up, and it goes in my favor. So what I do is I start like trailing that $5 risk, because if you keep that risk as $5 and the stock goes like $7, and it goes all the way to 5,
Yeah.
that's not a long anymore.
Yeah.
So you want to be on the trend. You want to
see.
be that that perfect uptrend when it
The
when it
higher
goes
highs,
crazy,
higher
highs,
lows,
higher
I see,
lows.
yeah.
And the VWAP also, remember that as I trade momentum stocks, VWAP is really relevant because it probably is the most volume in its history of the stock, and it probably is the highest volatility on its in its history.
Yeah.
The VWAP becomes really, really relevant. So I try to keep that trailing stop with the VWAP if it goes in my favor and if it's a long, for example.
And what happens if the stock starts consolidating? Because I can see that working really well if it just keeps on, especially if it's a low float stock, like goes from $5 to 10. I can see like that works really, that would be like picture perfect. What happens if a stock just start consolidating around $5? How would you, manage that
Lower
risk?
the size.
Okay.
Thing with the triangles is they don't reveal any of my technique, because if you could put the size of the triangle as my size, as my position sizing, that will be, revealing my edge. But as the triangles are the same, you wouldn't understand how I treat them. When it consolidates, I just lower my size because I just lost the edge.
Yeah.
I want to be in the trend. I want to be in those trends. So if I'm long bias and the trend goes up,
Yeah.
it's perfect for me. But if it starts consolidating, I don't want to be in the trade with too much size. Maybe I could hold a little bit just because the consolidation might indicate another leg up, for example. And if it breaks, I'm so close to my risk that I wouldn't mind. So what I try to do in consolidations is lower a little bit my size. They usually do it on midday. So I don't like to trade a lot of size on midday.
Yeah.
I usually do trade on middays, specific opportunities, and if they don't appear, like I don't trade on midday. But I usually go a lot of time, trading in the whole day.
So just to clarify, the arrows the triangles you're talking about are the execution arrows, right?
Yes.
The shorts, the longs, okay.
Yes, the sells and the buys.
I see. Yeah, I think a lot of people will mistake how much arrows you have as scalping. But you're saying that that's one entire position instead of in and out, in and out.
Yes,
okay, that makes sense.
Because scalping would be if I get in at 5:10 and get out at 5:13. That's not what I do.
Yeah.
What I try to do is I try to build my position around a core. The trading around the core, that's pretty famous.
Yeah.
Phrase. The trading around the core thing, what gives you is, okay, you have this risk level, and all you have to do is position yourself near that risk level so that your bias will tell you you're right by, pushing the stock up.
Okay.
That's pretty much what I do.
Yeah. I think that makes a lot of sense on an execution standpoint.
Do you have less of a headache when I explain you that?
No, if I see a chart right now on screen, I'm going to be like, oh, this is like 1,000 different arrows on one chart.
I understand.
Yeah, but I think now that you explained it, it makes a lot more sense. That's why
totally.
recycling
and
makes
if you
sense.
see it,
Yeah.
if you see it in live, like I trade with my team.
Yeah.
And if you see it live and you understand that it's position sizing and risk management, what you're doing by getting in and out, in and out, in and out, and getting this core position, like what you said, 2,000 shares. What you're trying to leave is 1,500 shares. And with those 500 is the recycling. The recycling would be with a little portion of your size.
I see.
That's pretty much it.
Okay.
I'm revealing all my edge here. So there's nobody, like, too many people watching, right?
No.
Oh,
Maybe
thank
like
God.
10 people if we're lucky.
Thank God.
Yeah. Eduardo just shared a lot with us about his struggles both as a trader and as an immigrant. Does his story remind you of the past, or does it inspire you to keep pushing forward in this very unique path? Let me know your thoughts in the comment section below. So let's take a step back and talk about how you get to your bias. Because you mentioned that before you take a trade, you'll do the research on the stock and achieve the bias of whether you want to be long bias or short bias, given the price action and fundamentals. So what's your research process like?
Okay, for
before
example,
you take a trade on
of
this
course,
particular stock?
I do it like this. Like, what's a perfect long and what's a perfect short? If a perfect long has these characteristics that I'm going to tell you, and this stock fits in this perfect long, that will be my bias. But as you know, obviously you're going to have red flags all over.
Yeah.
You're going to have, it's really, really hard to get all the stars aligned. So, for example, a perfect long, that would be no dilution, not overextension. Overextension would be, I don't like a stock that is 1,000% up. Well, on TPST, you never know, right?
Yeah.
You went to 4,000%.
Especially when it came from a penny stock, like an actual penny stock.
No, that's crazy. We're seeing a lot of crazy things.
Yeah.
But like on a regular basis, you don't want to see something that is 100% up. You want to see something like 50%. You want to see extension though, because you want those short sellers to be attacking.
Yeah.
So you have to have that extension, but it doesn't have to be like 100%. Then I rather not to have dilution, because if you have like an ATM or you have like warrants, obviously they're going to be converting those warrants into stock, or they're going to be diluting a lot of shares. So that's not good for a long. Lately, you got these people like pumping stocks that were like really dilutive kind of stocks. So they got those crazy short squeezes. But regularly, you don't want to see a dilution on a stock. So you got to have volume rotating the float. So you have like a 10 million float on a stock, you want to see 20 million volume, something like that.
Is this buy the open, or you want to see all these things pre-market?
Like on pre-market, I tend to multiply by 7, the volume in pre-market. I tend to multiply it by 7, so I can know like a range of what the volume would be on the day. Obviously, it's not accurate.
I've heard ×4 or ×7, either or.
Yeah, I do it ×7. So you probably have that. And if I see that it could rotate the float a lot, that'll be ideal. Then the other thing, you got to have a catalyst. If you don't have a catalyst, and you have to have a strong catalyst, something like a contract, something like, that brings revenue to the company, that's ideal. And you don't have to have, it's really important that you don't have overhead resistance. Like if you have overhead resistance with volume, like you just look left at the chart. And if that thing, if the price is below the level that has volume, you don't want that in a perfect long. So those criteria, I think I probably missed one or two, but those are the criteria that I see in a perfect long. And in a short,
it'll be the opposite.
It's easy. It's just, what I do is, when I try to teach these things, there's a feature in Thinkorswim where you just put a minus symbol before the ticker. Yeah, and you flip
the chart. Okay.
That's pretty much it. Like it's the same. That's why I'm telling you that I'm really like a price-driven trader.
Yeah.
And that's why I probably go 60-40 or 50-50 on the long and shorts, because you have so many good opportunities on whenever a really, really good short sets in and it doesn't go your way, that's probably opening an opportunity for a long.
Yeah.
Because you get so many short sellers. Like dilution, it's so important to have dilution when you're a short seller. And if the price keeps going, that means that probably either the dilution is already done because the volume overwhelmed all the supply that it created with the new shares, or they just don't want to sell still.
Or they're holding it till the next day.
Of course, they're holding it.
More people.
Of course. So you never know where these things are coming. But when you have so many short sellers in one side of the trade, and that's what we're seeing a lot lately, the liquidity is so important. Like we don't have the same liquidity that we used to in 2020 and 2021. So if you have tons of people in the same side of the trade, that thing could go 4,000%, I foresee.
Yeah,
right? So
especially now that short selling has gotten so popular
and easy to do with the new brokers.
Yeah.
And, back then it was so hard to get borrows and stuff. Now you get all these brokers, providing all these amazing deals to get locates that anybody could get locates. And there's so many people in the same side of the trade that if you understand the other side of the trade, you can have it as an edge. And if you see a perfect short that becomes a long probably at 11 or 10:30 in the morning, that'll be such a good long too. So that's why I try to be flexible on my bias, and I'm really, really aware of the price action. So that's why I'm telling you, if this risk level is broken, there's no way that this is a perfect short. There's no way that I'll be in that trade.
That makes sense. So let me just sum up. You just shared a lot of golden snippets about your strategy. Let me just kind of sum it up a little bit. So how you pick stocks is basically you want to see, for a perfect long, you want to see a stock with no dilution on the SEC filings. You want to see a high percentage gapper, but not too high. So maybe 50%, right? You want to see, volume forecasting to be above the average daily volume, usually times 7. Right?
No,
from pre-market?
No, that'll be the flow rotation.
Right.
Because you can have a stock that probably on an average is trading 50,000 shares or less.
Yeah.
And if you get 1 million shares and the float is 10 million, I'm not interested.
Seven times the float.
Yeah. The volume in pre-market. Because I see gappers a lot.
Yeah.
So if you see a stock that has 10 million 5 million float, for example. If you see 5 million float, and if you see the volume in pre-market is 5 million, you will see that stock will have a flow rotation, a really high flow rotation.
Yeah.
And that's what I like to see.
Okay. And you don't want to see too much overhead resistance on the daily if you're long. Okay, that makes sense. And basically, you don't want the stock to break down that key level.
Yeah, I have a lot of I have a couple of strategies, a really, really detailed strategies in my playbook, so I can know, for example, a stock that is red in the day and below BWAP has to have really, really, really good conviction in order for me to trade it in the long side. It has to have crazy catalysts. It have to have really, really strong things that are not price, and it has to have holding a key level.
Yeah.
If it's downtrending, one of my worst losses becomes from that conviction of this is a long, it cannot be, that fighting between the fundamentals and what the price is telling you. The price is telling you, no, bro, I'm going down. Why would you keep buying? And I'm still no, you gotta go up. That's where my worst losses come from. So I try to be really aware of what the price is telling me, and that's why my risk has to be a key level on the chart.
Yeah, I can kind of see what you mean by that. I think a lot of traders, especially the short sellers, they get so much conviction from the SEC filings research. Sometimes they ended up backcoding, a little bit too much just because they have so much conviction.
And that's the thing about small caps. 90% of small caps, revenue, they don't make any revenue.
Yeah.
If you see the financials, it's crazy. They're crappy companies. And that's why you get so much conviction on the short side.
Yeah.
And that's why you get so many percentage of accuracy on the short side. Because 80% of them, if you check the tool that I'm using right now in order to check the gappers and all those things, you will see that probably 85% of the gappers, more than 100%, they all close red.
Eventually. Yeah.
No, that day, first day.
But a lot of them, they can spike from let's say $1 to 10 before coming back down.
That's the 20%.
Yeah.
So the 80% of them, of all the gappers of 100%, blah, 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 I could check the specific statistics. Maybe it's 79, maybe it's 81.
Yeah.
But overall, if you see a small cap that gaps 80%, 100%, 80% of those close right on the day. If they're not right on the day, don't short them. It's that easy. But sometimes you get so much conviction that it will go down that you keep fighting the stock, and you end up like the broker will eventually buy in your shares because you're not, providing the margin that it requires. And that's why they, and as liquidity is low, they go up so much.
Yeah. Basically what you're saying is 80% of the time, shorting small caps is like, definitely going to be a profitable strategy. But it's what you do with the 20% that blow up a lot of shorts.
Of course. Yeah. Because the thing about short selling is it's so risky. It's so risky because if you're not aware of it, and if you like be a deer on the lights, like
deer in the headlights.
Yeah, you get freeze. I've felt that. I don't know if you have felt that.
That's ever. Me with that ticker. We all have that ticker.
SPI, what's mine?
Oh, mine was BPTH.
Oh my God! Yeah, I saw that. Well, SPI was really similar dates. Yeah, it's like 2021, I think.
I think SPI is recurring though. I think BPTH was 2019.
The SPI was 2021, and it went from 1 to 60.
Yeah.
And I shorted in the 35. It was such an amazing entry, but it went all the way to 61st. And I was like, oh no. It was like that feeling. Once you experience that feeling, that's why I think it's really important for you to, if you want to be a long bias or a short bias trader, you got to understand the other side of the trade. Mm-hmm. And if you understand what shorts are feeling once they're getting squeezed, you will know that it's a good, like there's an opportunity and there's a window of opportunity. There's a really, really good long in that kind of situation. So that's why it's really, really important to understand what the other side of the trade's feeling and what is thinking. In a way.
Have you been in situations where, just like you said, you were short, you were heavily short, and you were stuck trying to get out, and you realize, hey, this is like a perfect long now, you switch?
Well, I think one of the things that I have, like my thing, I know how to flip bias like really, really well because I'm really flexible guy. Like my personality, like I'm really, really flexible. I'm not like determined, like, yeah, this has to be it. No, this is my position. And no, I'm like,
that's good.
Yeah, I could be wrong. Yeah. And I know I could be wrong. So I don't mind to be wrong. There's sometimes obviously that you're so convinced, like so convinced. No. That's why I think fundamentals are really tricky when you're trading momentum. Because
it matters, but it doesn't really matter.
It matters a lot. You have to know that this stock has dilution. You have to know that this thing has, warrants or whatever, a lockup period or whatever. But if you're trading the momentum, madness could set in.
Yeah.
And especially if you see all these liquidation plays in Chinese IPOs, like recent IPOs, and where you see like what we saw on MTC a couple of days ago, I think it was on Thursday or Friday, and you see that crazy momentum going, and if you eventually will be right on the small caps, like eventually you will, but you can how's that phrase? You can be. The market could be more irrational than you can be solvent.
Oh yeah, for sure. Yeah,
you could blow up before you're right.
Yeah, so you'll eventually be right, but you might not survive.
Of course, you might not survive that crazy run up at first. Mm-hmm. So that's why it's so important to you gotta understand filings. You gotta understand every single detail on the fundamental because you gotta know what you're trading. You gotta do your due diligence. But my weight would be more on the price when I'm trading momentum. When I'm trading some stock that is overextended in a few days and volume is decreasing and all those things, like fundamentals kick a little bit more.
Yeah.
But I think price action is key when you're trading momentum.
Yeah. You don't want to be fundamentally right, but technically wrong.
Oh my God, you don't. Yeah. Definitely.
So we talked about earlier that you only trade small caps. So what do you think about the small cap environment this year? Is it more competitive? Is it more difficult to make money?
I think it's difficult to adapt lately because it's so illiquid, that, for example, 2020 and 2021 was the perfect market.
Yeah.
And everybody made money in the 2021. But 2022, it went like really, really steady and less volatility. But liquidity was not a thing. Right now, you're getting a lot of volatility, more, I think more than 2022, but you're getting less liquidity. And you get this, like, it's not like momentum sectors, for example, and what you got from oil and gas on March of 2022, for example, what you got from AI on January on 2023, you're not getting that. You're getting these crazy moves that they don't have enough liquidity, and you get so much volatility that is so dangerous to trade them that you gotta adapt really, really quick. So what I feel is the most difficult thing to trade small caps right now is that you get this crazy change of environment in 2 or 3 days that you think is gonna change, and it doesn't change. Like, I think that's probably the hardest thing that got me. But as I am really flexible, like, I managed to keep a really consistent profitability trading small caps. Like, I really understand them. Like, I'm really in sync with them. So I don't think it's hard.
So how would you adapt? Do you just size down more and scale in and out more? Okay.
A lot. Like, that's my thing. Like, if I see that my equity curve is what dictates my size and my conviction on the market, whether I'm in sync of the market or not. If I'm in a huge drawdown, it means that I'm not understanding the market, and I should size down so I can understand the market first, and then push it up whenever I in sync again. So this year, I haven't had a lot of drawdowns, but this past month, I had huge drawdowns. But that was because I'm trying to escalate my strategy, and I'm trying to push my size a little bit more.
Okay.
And psychologically, that was so hard. Like, that was so hard. So I think my drawdowns comes more from what I did than from the market is doing.
Okay.
So I think if you are in a market that you don't understand quite well, you gotta size down, or you don't even trade it at all. But you gotta be in sync with the market first. And the difficulty this year would be that you see 3 or 4 days and you think the market is changing, and then it drops again.
Okay.
So I think it's that, like, adaptability in this market environment is a lot harder than you got in 2021 or even 2022.
So can we hone into what you just mentioned about your drawdown a little bit the past month? So you're saying you're experiencing a drawdown because it's okay. Do you need some tissue? It's okay. You got this. I didn't mean to make you cry. But for these drawdowns, are you saying that you are experiencing the drawdown because you're trying to push size in an illiquid market environment?
I think what size does to you is the unrealized profit that you see.
Yeah.
It's harder to manage in a way. So I get clouded for my decisions when I see such a volatility in my unrealized. Okay. So I think it's a matter of tolerance. I think it's a matter of risk tolerance that I'm pushing it. But that's so good. Like, that made me such a better trader just because I'm able to handle the swings of P&L more. Like, when I size down, I had the huge drawdown and I sized down. Now that I sized down, it's so easy for me. Like, so easy. Like, psychologically, a loss of $3,000 was really, like, maybe I got a little bit shaken, probably 5 months ago or something. Now, a loss of 3,000, it's like nothing. Already lost like 20K. Already been losing like 10K, 15K. And it does something to you. I think it gets you like more, I don't know, harder in a way, and you get more darker in a way. I don't know how to say it.
Okay.
But that risk tolerance allows you to, as you go sizing down, allows you to see the chart better when you size down to your former large size.
I see.
You know?
So let's say when you take the losses, you were trading, let's just say 5,000 shares, you size down to 1,000 and you find that you're trading better. And you are more, like you said, detached from the money.
100%. And maybe it's not detached, because that's hard. Like I try to be detached from money all the time. I try to trade points all the time. I don't like to trade my rent. I don't like to trade, my kids' education. I don't like to trade that. But there's some times that you do. Like it's really, really hard to be completely detached from money. I even have this $20 bill in front of my desktop, just because I got so detached from money that I had to, bring myself down to earth so I can understand that I'm trading money.
Okay.
But this is not about detaching from money. I think it's about risk tolerance. It's about what you can handle. So if you could handle $3,000 loss, for example, and you go big on setups, like $3,000. I don't care to lose $3,000. Now that you lose 15, your risk tolerance that you had when you lost 3K, it's nothing. Like you don't get that, insecurity, or you don't get that, cloudness in your decisions when your risk tolerance is way bigger. So that's why I think sizing down is so important when you want to understand what you're doing.
Yeah.
But it's been really important for you to push it too. Because if you don't push, if you don't get uncomfortable, that former size wouldn't be former ever. Like you'll be so comfortable of the same size that you'll not be pushing yourself to. One of the things that I love about trading is that you're not capped. Like you're not, if you make this amount of money, like you're not be able to,
It's not like a salary where you have a cap.
That's right.
Yeah, I get what you're saying.
That's right. So if you push yourself, you could aspire to get more money. And not only money, because it's not a matter of money already. It's a matter of being better. It's a matter of growth. It's a matter of, and that's what keeps you trading better and better. Because if you trade the same way that you traded a year ago, you know that you will lose a lot of money. So you got to be better in order to be the same in money-wise. So you got to push yourself in order to become better in that risk tolerance kind of part of your trading.
I know just earlier you mentioned the importance of downsizing when you are going through a drawdown, just to kind of recollect yourself, regain your confidence, and kind of, like you said, like when you were losing 10,000, you size down, now you're risking 3,000, you can actually trade better, right? So I think a lot of newer traders, they tend to do the opposite, where they're in a drawdown. Let's say they are losing $1,000. They're sizing even more so they can make that $1,000 back.
So they can recover it. And you know why? You know what? See it this other way. When you're winning money, you got to push it more.
Yeah.
People don't. People size down when they're winning money because there's so much fear to lose the money that you're gaining.
Yeah.
And it's so much urgency to gain back the money that you're lost that you got to backwards. When you're earning money, that means that you're in sync with the market. So that's why I'm telling you that my equity curve will dictate my size. If my equity curve is up on a month, I go.
Okay,
and
that makes
up.
sense. Yeah, that means you're trading well as well.
Of course, and you're in sync with the market.
Yeah.
If you push it, you get uncomfortable. That's where things start happening because you're pushing it, and psychologically you're not making the best decisions. You might get a drawdown. What does your P&L tells you? Size down. That's why it's really important that people understand that if you're in sync with the market, go for it.
Yeah.
Maybe not risk all of what you gain, but you got to risk more so you can take advantage of your your synchronization with the market. If you're losing money, stop losing money. You know,
Stop risking so much. Yeah.
Stop the bleeding.
Thank you for sharing so much insights with how you kind of manage your risk and dial up or down with your position sizing. So if you don't mind sharing from your perspective and the way you trade, what's kind of like your typical risk-reward ratio when you are trading and recycling your shares? And is that important to you?
I suck at it, actually. There's a thing that I think personality is really, really important when you're trading.
Okay.
And I am kind of a guy that likes to be right because my confidence goes up, and that way I can perform better. So I'm a really an accuracy kind of trader. So if you see my statistics, I'm right like 77% of the times.
Okay.
But my risk reward sucks. Like my risk
so
reward.
you're aiming for high win rate.
Higher win rate.
I see.
Yeah. But when I'm teaching and when I'm being a coach, I always try people to aim for that 2-to-1. Because if you don't get the risk reward on your side, it's really, really hard for you to take advantage of the real opportunities. Like you'll see a lot of opportunities, especially in small caps and especially in the long side. Like there's so many opportunities that it's not a matter of risk reward even. It's a matter of, understanding what the stock is doing so you can squeeze everything, like maximize every single unit of risk that you're putting in. You got to maximize it. So as I trade every day, and like I literally trade every day since like my probably last 5 years, I would probably have lost maybe like 20 days on my trading. Like I trade every day. So I probably don't seize, like that's what I'm working on the most. I probably don't seize opportunity as I would. And that's why my risk reward, it's so lame. Like it's really, really bad, especially in the weeks that I'm really, really, for this October has been like really, really bad for me. I still like managed to break even on the month. I don't know how, but if you see my risk reward is like 1 to 3 or something like that. Like it's
risk
really,
reward.
really bad.
Oh, so
like
3 to 1
yeah,
risk reward.
Like
okay.
I risk 3 units to gain 1.
Oh,
so
I see.
bad. But I compensate that with the
high win rate.
With the high winning rate. But that means that I get so stubborn on some trades.
Yeah.
Lose probably 10, 20 grand on a stock.
I see.
But I gain probably 7.
Gotcha.
So that's something that I'm working on. And that's something that size did to me. Like the size, when I pushed the size, it was so hard to be flexible. The flexibility that we were talking about.
Yeah.
It was so hard. It was harder. And that's why I think I got into all those losses.
What's your biggest loss ever, if you don't mind sharing?
I don't remember quite well, but if I have to say, I probably have like 4 of probably the same amount. But the one that shocked me the most was SPI. Like shorting SPI was shorting that parabolic move. Like it was huge parabolic move back in 2021. And I remember that I was probably at the 35 or so. I did have a great entry, and it went all the way to the 60s. And it was...
Oh, no.
And I keep adding and adding and adding.
Okay.
And it was so bad.
It's one of those, like what you said earlier, deer in the headlights events.
100%. It was so hard to... And that... I'm so grateful for that loss because it led me to ever short something like that again. And more than that, take advantage from them and flip on the long side.
Yeah. Instead of keep adding shorts, you should just cut your loss and go long.
Of course.
It's easier said than done, for sure. But
So
I think
hard.
it's good that you're like kind of neutral. You're not too short biased. You're not too long biased.
I think if you haven't ever felt that before, you couldn't talk about it.
Yeah, deer in the headlights moment.
People think that it's so easy to say, hey, cut it. And if you see the other people doing it, you see them like digging their grave. You go like, oh, stop.
Right.
And But when you are in that screen and you see that thing going against you, and it's just a matter of, as you know that there will be a pullback, you're like, I'll just wait for the next pullback.
Yeah.
And it keeps halting up, halting on. It's so powerful that I don't even know how to describe it. But if you feel that, you can understand whenever you see something like that again, you will know what the other side of the trade is thinking and feeling.
Thank you so much for sharing the recent drawdown you're experiencing. When you're going through kind of losses day after day, how do you deal with these losses? Because they slowly add up.
Yeah, I think it's really important that the first thing you have to do is see it as it is and not worse than it is. Because sometimes we get like, okay, I lost this kind of money. I'm the worst trader in the world. I don't like you get to question yourself a lot. And that's not it. That you just made a mistake. You just lost money and you could fix it. And whenever you approach that loss in that way, it's so much easier to deal with it than if rather you go like, yeah, I'm the worst trader in the world. How can I do that? Or am I good for this? Am I sufficient enough for this?
You want to quit, kind of.
Yeah, totally. Yeah. So it's not that. You made a mistake. You have to deal with it and see it as it is, not worse than it is. That's the first thing. And for that, you might take a walk or something like that to chill and to cool off all those crazy thoughts that you get. Then I think it's really important to reflect technically what you did wrong. So you can set your rules, because sometimes we bypass our rules just because we get away with it sometimes.
Yeah.
And rules are there just to avoid days like that. So it's really important that you reflect technically what you did wrong so this never happens again. And then it's really, really important that you focus on gaining your confidence back rather than money. And that's why sizing down is so important. That if you can get that good trade on the next day, it's much more important than getting all the money back.
Yeah.
Because if you get all the money back and you're not reflecting what you're doing, you're going to experience.
Yeah, you didn't learn anything.
You didn't learn anything.
Yeah.
So that's why it's really important for you to reflect, size down, and look for that confidence back rather than money.
Is that kind of the process you've been doing the last couple of weeks? And how's that going right now?
It's doing well.
Okay.
Thing is, whenever I had the chance to push it again, because I lost half of my drawdown in a week, I push it more and I had another drawdown. And what I saw is, okay, maybe this is not only a technical thing, maybe it's a psychological thing. Maybe it's something that I'm doing or maybe it's something that I'm going through that I bypass my rules or bypass my technical rules, or something that I have to add in that process. So that's why adapting and adjusting is so important for traders. And you gotta have, this is really important, that the journaling part, you gotta understand your statistics and you gotta understand what you're good at. So when you see that pattern that you're really, really good at, push it. And when you see that pattern that you're really, really awful at, just avoid it.
So speaking of statistics, how do you track it personally for yourself? Do you use any software or do you use a manual Excel tracking?
I use a software. I use Tradervoo.
Okay.
I use Kinfo for transparency purposes. And I use Tradervoo for really being detailed on, for example, the setup that I'm good at, the setup that I'm not good at. I know that I'm not good at large cap, for example, because I know every time I trade them, I suck at it. So that's why it's really, really important that you get that knowledge of yourself by knowing your statistics and journaling for whatever adapting to that market means to you.
So I know nowadays you're also an educator in the trading space, specifically for the Spanish-speaking traders. How did you get into that, and kind of what inspired you, and what's your mission with educating people to trade?
Well, first, there's lack of knowledge and lack of understanding of the trading environment in the Spanish-speaking community. They see it as really skeptical kind of thing. And that's why I try to be really, really transparent with all this journey and with all this process, so people can see that it's possible. Because here in the States, for example, it's really normal for people to, get an account and trade and get a broker and all those things.
Yeah, especially after 2021.
Especially after 2021. And especially because you might know someone, or you might see someone that is successful at trading and is not trying to sell you courses and stuff.
Yeah.
In the Spanish-speaking community, is the other way around. Is people who try to scam and people to try to, as it is in the English community too, but you see a lot of real people in the English-speaking community and all the way. But in the Spanish-speaking community, is more skeptical. It's more like, this guy wants to, wants my money and all those things. So I saw that in the, we had a lot of lack of that, lack of transparency, lack of honesty. And I was like, okay, there's an opportunity here for people to understand that it's not only Forex and futures. That's one thing.
Yeah.
For me, equities are if you're starting trading, understanding equities, because of the supply and demand, understanding equities is probably the best first step for you to understand what trading is. So I think that part, that concept of the supply and demand, and that concept of being centralized by NASDAQ or New York Stock Exchange, that gives you a little bit more of an edge. And that's why I try to, give the Spanish-speaking community that perspective of a different market that is not Forex and futures, and from someone that actually does it every day.
Yeah, I know Forex trading and futures trading is big, but I personally know more day traders who make a living out of trading stocks. I'm not saying futures trading and Forex trading is not possible, but I just feel like there's a lot more, it's a lot more inefficient in the stock market, equities.
And I think as you have a lot of large players, because you have tons of liquidity, so large players become involved in these markets like Forex and futures, and that's harder for, the little fish.
For sure. Any advice or message you want to give to our audience watching this?
If you're beginning to trade, manage your expectations. Research. Trade small. Start small. You don't have to trade with thousands of dollars. Trade small, with one share. It doesn't matter, because the first thing you need to understand is that you're acquiring a skill. And this skill is probably one of the most lucrative skill there is in the world. So respect it, treat it as a profession, and give it time. Give it time, because it's totally worth it.
Where can everyone find you on social media?
My Twitter and Instagram, it's @edu_trades.
Thank you, Eduardo. Thanks for your time today.
I had a great time. Thank you so much.
If you enjoyed our conversation with Eduardo today, make sure to hit the like button down below. Also, if you want to hear more stories from other inspiring traders, then check out this video over here.